Hello and welcome to Currency Point, presented by me, Evan Lucas, for FP Markets. As always, please have a very good read through of the disclaimer on screen. Everything in this video is general in nature, none are relied upon as any form of personal advice. FP Markets does not know your personal scenario, nor your personal financial goals, and therefore none are relied upon as any form of advice. It's all is just general in nature only. All things lead to more hikes, and I think that needs to be part of your base case. The question is whether or not the Fed's becoming data dependent. It isn't. And that needs to be pointed out very clearly because some people are trying to allude to that. And the reason you know that is that you can hear it from the board members. And again, at the moment, the trade is, and the way to trade the whole thing is just to listen to what the board is saying. Because even their most dovish members, someone like Neil Kashkari, is still talking about not only rate rises, but continuous rate rises. He points out very clearly September's most likely to be 50 basis points in his view. And then again in November and in December, that rates are going to remain fairly elevated to probably June next year. And he's the most dovish out of them. Then you look at someone like Mary Daly, for instance, from San Francisco. She's a centralist. She's basically pushing the line that it's raise and hold in where they sit. She believes that, also 50 to 75. She was happy to go with a 75 basis point rate rise in July. And the probability of her doing that in September actually, I think, is quite elevated. And therefore, that should be how you look at things and where they sit. She believes that the federal funds rate will be above or at 3% come Christmas, and just slightly higher than that through most of next year. Now, the federal funds rate might be there on the board's perspective, but the market thinks that it's going to start declining in 2023. That's why you need to listen to someone like Jamie Bullard. Okay, caveat and the hashtag and whatever else you want to put next to his name, even being the uber hawk on the board, is that he thinks it's way too early to be talking about easing. And that he thinks that rates need to get to probably 3.75, maybe even 4%, by the end of next year. Now that is serious over-tightening. That would be well past neutral rate. That would put some real pressure and some real squeeze on the board and also on what the Federal Reserve thinks, because that would push things to the idea of a recession quite front to the fore. And Neil Kashkari says that. He said it's going to be hard for the board to get away with actually not causing a recession. And then you look at someone like Ester George, who is normally considered a hawk, but even she's a little bit backing away from someone as strong as Jamie Bullard, wanting to raise rates still. And you can see this now coming home to roost. 6th consecutive month that existing home sales in the States have fallen and fallen quite dramatically. 4.81 million new existing home sales done in the last month, down from well in the 5 mil. And it's been falling like a stone. In fact, it's now at the lowest level we've seen in terms of rates for almost a decade. And that's not surprising. And it's only going to slow even further. Now, that has an effect on the wealth effect, all well and good. It also means it will slow down inflation. But if you do over-tighten, that risk around recession is there. We know that. It's just a question of whether or not it's an excessive risk and therefore causes an extended period of recessionary flavors. And that's why the market is pricing the idea that rates will ease next year rather than hike. But all roads still therefore means it leads to the USD, because we're looking at FX, and FX right now is only leading one way. Any softness in the US dollar, even if it's for a couple of weeks, is quickly soaked up. And you can see that euro dollar is basically back at parity. You look at cable, 119 and still wanting to go lower still. Dollar yen, which has had no reason to move because there was no movements in real yields, is back at 135.5. Aussie dollar cannot get back above 70 cents, and not surprising. And it's because the US dollar is so attractive, because it is going to be zero risk, high real return, and money therefore inflow is huge. And that's why until any of this changes over the next 6 months, the US dollar remains the absolute key and base play to where most people in FX are looking.